Good afternoon for the ones that are in the EU, and have a great morning or a great evening in the rest of the world. So welcome to this webinar dedicated to the standard setting activities of EFRAG regarding what we call the non-EU undertakings companies. Let me share with you three opening remarks. The first one is that there are several ways for a non-EU group to be, to have to consider CSRD, Corporate Sustainability Reporting Directive, and European Sustainability Reporting Standards, ESRS. Of course, if you have subsidiaries that are in the scope of the CSRD, then in the EU, so these subsidiaries would have to prepare a report unless they can benefit from what is called the subsidiary exemption, which will be covered in this presentation later. The second point is, of course, if a non-EU undertaking company is listed on a regulated market of the EU, then this company has to apply the ESRS in full. So what we call at EFRAG and in general terms, we call Set 1. So the sector agnostic standards that have been published on July 31st, 2023. And the last, which is the one we are going to cover today, is the provision in CSRD called Article 40A, which is establishing that a non-EU headquartered entity having significant business in the EU, and the criteria will be mentioned later, have to report at group level on a certain number of matters which are similar but with exclusion to the ones that EU companies have to report. The objective being to create a level playing field for companies competing on the single market. So that's the first introductory remark which I wanted to make. The second one is that at EFRAG, we have established a direction of travel, but there are still a number of steps to be covered before EFRAG is in a position to deliver its technical advice to the European Commission. So direction of travel will be explained during this meeting. And we are at drafting stage of what we call an exposure draft. Exposure draft will be consulted upon, so via a public consultation in the first part of 2025. So what I'm talking about is the due process under which we prepare standards on the basis of the mandate that we received from the European Commission and the European institutions. So first of all, the direction of travel, strategic direction, then the drafting of an exposure draft, then a public consultation. Public consultation basically is for 4 months, which means that we would be probably finishing this in the second quarter of 2025. After that, we of course have to take account of and elaborate on the feedback that we receive. Normally, we receive a huge amount of comments on exposure drafts. When we, at the same time as we have the public consultation, we perform a cost-benefit analysis, which is mandatory under the better regulation approach in the EU. And we also organize field testing. On the basis of public consultation, field testing, and cost-benefit analysis, as from the end of the second quarter of 2025, we will be fine-tuning the draft standard, which we agreed with the Commission should be delivered by EFRAG as technical advice at the end of 2025. So timing-wise and due process-wise, I wanted to give you this overview of how we are going to move forward on this critical aspect. The third point is that, of course, we realize that it is important both for European businesses and for non-European businesses. We have made a commitment from day one when we started working on sustainability reporting more than 4 years ago, that we would at the same time, of course, elaborate standards in line with the expectations of EU stakeholders and the capacity of EU businesses, but that also we would support the global momentum on sustainability reporting and support the global baseline in particular. Therefore, interoperability with the ISSB, with GRI, with TNFD, in order to make sure that companies reporting under ESRS or companies reporting under frameworks would not be lost and would have a capacity to move from one to the other. In particular, ESRS reporters will be complying with ISSB. ESRS reporters will be also reporting with reference to GRI at a high level of commonality, and the TNFD and even TISFD in the future disclosure requirements will be somehow embedded into the standards. So these are the 3 points which I wanted to make, and without further ado, so we are very glad to welcome Giulia Bottazzi from the Commission that will give us the legal aspects on this complex matter, and she will answer your questions. After that, we will tell you how we have organized our work and on what basis, what direction of travel. So without further ado, Giulia, the floor is yours.
Thank you very much, Patrick, for the introduction, and good morning, good afternoon, and good evening to all of you, depending on the time zone. Before I started this presentation, I would like to reiterate a message that Patrick has already conveyed, which is there are mainly 2 cases where non-EU companies fall under the scope of the CSRD. Meaning that it has to report on sustainability. And those cases are 2. One is when that non-EU company is listed on the EU regulated markets. But in that case, and this is not the topic of this webinar, in that case, that company would have to report on sustainability under full ESRS. And based on a timeline that depends on the size of the company. So the biggest company from financial year 2024, then financial year 2025, and listed SMEs in financial year 2026. But this is, again, not the scope of this webinar in particular. The scope of this webinar covers the option number 2, when a non-EU company is not listed on the EU regulated market, but has a net turnover above 150 million, and it has business in the EU, meaning, and we will see it later in detail, it has subsidiaries or branches in the EU. So that said, we can start with the presentation. I will share my screen, and please let me know if it is working properly and if you can hear me well.
Yes, everything perfect. Thank you, Giulia.
Perfect. Thank you very much, Frederick. So again, this is going to be a legalistic presentation, but I will try to make it digestible. It concerns Article 48 to 40D of the Accounting Directive, which are the ones that cover this second option for non-EU companies not listed on the EU regulated markets. You will see some legal references in the presentation. Those are mainly for the lawyers in the audience, so you can have a look at what the directive says in detail. I will not mention it orally, and the slides are trying to give a more digestible presentation of the EU rules for the sustainability reporting concerning these types of third country companies. So the presentation will basically cover the scope of Article 40A, meaning which non-EU companies are supposed to be covered by this obligation. Then we will see together what are the obligations for their EU subsidiaries or branches. We will see what is the requirements when it comes to digitalization and assurance, which standards needs to be used for these types of disclosures. What are the requirements for the publication of the information, the responsibility of the companies for the drawing up and the publication of the information, and lastly, what are the requirements also from the side of the Commission. So starting from the scope, as I said before, these obligations, Article 40A covers companies that are not established in the EU, and they're not listed on an EU regulated market. They need to have a net turnover generated in the Union above 150 million in each of the last 2 consecutive financial years. And on top of this condition, there has to be one additional alternative condition. Either they need to be the ultimate parent of EU subsidiaries that are either large undertakings or listed SMEs, meaning that they're ultimate parent of EU subsidiaries captured by the CSRD, or in the absence of these EU subsidiaries, they need to have EU branches with net turnover above 40 million in the preceding financial year. That said, in practice, the content of the sustainability report, which is the document that needs to be published, is slightly different from the content of the sustainability statement, we call it like this for the ESRS full. You will see that the information is different in terms of content and different in terms of materiality. But I will read a little bit. I have to go a bit into details in this slide. Apologies for that, but it's for clarity purposes. So basically, what we're speaking of with the sustainability report concerns the plans of the group for the transition to a sustainable economy. Basically, the transition plans, how they're called, the business model and strategy of the group to take account of the interest of the group stakeholders and the impacts of the group on sustainability matters, and how the group strategy has been implemented with regard to sustainability matters. Then we have time-bound targets, always, of course, related to sustainability matters, the role and expertise of the managers, with regard to sustainability matters, the group's policy, the existence of the exempting schemes, the description of the due diligence process, actual or potential adverse impacts connected with the group's own operation and value chain, actions to identify and monitor those impacts, and the actions taken by the group to prevent, mitigate, remediate, bring to an end these potential adverse impact, as well as the result of these actions. And lastly, the relevant indicators where appropriate. So it is mainly the impact on sustainability matters and not the risks and opportunity. But there are nuances, and here we are trying to summarize, but you will see it more in detail later in the following session. The information needs to be disclosed at the group level of that ultimate non-EU parent company. Group level, of course, it's in bracket because if the non-EU company does not have EU subsidiaries but only has a branch, of course, it wouldn't count as a group. So this is why it is written like this. And one important point that we would like to make, the Article 8 taxonomy regulation disclosures, which are included in the sustainability statement under ESRS full, are not required in the sustainability report. So if a non-EU company is not listed on the EU regulated markets and fall under 40A, Article 8 taxonomy disclosures are not required. But let's speak of what are the specific requirements for the EU subsidiaries and the branches of this non-EU company that falls under the scope of 40A, because the requirements under the accounting directive are directly for the subsidiaries or the branches and not directly on the non-EU company. EU subsidiaries and branches need to publish and make accessible this document, this sustainability report, with the information that we've seen before. And this document needs to be accompanied by an assurance opinion. Where applicable, and we will see in which cases, it is possible that the information that the EU subsidiary and the branch needs to disclose is not available. And in that case, it would have to request a non-EU company, the mother, to provide all the necessary information. If the non-EU company, the mother, does not provide all the necessary information, then the EU subsidiary and the branch is required to publish a statement together with the sustainability report and the assurance opinion, a statement indicating that the non-EU company did not make the necessary information available. Also, the same principle applies in case the non-EU company does not provide an assurance opinion. And in that case, it is for the EU subsidiary or the branch to issue a statement indicating, indeed, that the non-EU company did not make the necessary assurance opinion available. Then there is another additional possible requirement that it's not an EU requirement, but it could be a requirement at national level, which is the need to send information to the relevant member state about net turnover generated in that member state and in the union by the non-EU company, so by the non-EU parent company. And the relevant member state, it is always the member state where the EU subsidiary that has to do the reporting is established, or the member state where the branch is located, of course. The ESRS to be used are indeed the so-called ESRS for certain non-EU companies, or NESRS. These are the ones to be used by default, and those are the ones that EFRAG has started developing, which will be later adopted by the Commission with a delegated act. Following, of course, all the also due process from our side concerning the consultations of the relevant EU bodies, etc. There is, however, and this is option B in the slide, the possibility, which is completely on a voluntary basis, for the non-EU company to comply with 40A by providing a full sustainability statement drafted in accordance with the ESRS full. So that would be purely voluntary, but that would give the advantage to the possibility to exempt the subsidiaries of that non-EU company, the EU subsidiaries of that non-EU company that are captured by CSRD, to be exempted from the reporting. And this obviously because we do not require double reporting. We do not want double reporting. So in the moment that the information is already available in the consolidated sustainability reporting of the parent, that would be sufficient to exempt the CSRD, the EU company subject to CSRD. Now we have the digitalization layer in the sense that at the moment, no digital format is required. So we do not require a specific format for the sustainability report to be published by the EU subsidiaries or branch. However, we would like to flag that there is an empowerment in the accounting directive for the Commission to adopt machine readability requirements. So, which means basically go into possible machine readability for the purposes of the accessibility of the sustainability report on ESAP, which is the European Single Access Point, which is being now established by ESMA, is not there yet, but it will be up and running in 2026 for companies' public financial and sustainability information. And the sustainability report in particular, and all the statements that are required under 40A will be accessible on ESA from January 2028. The assurance of sustainability report is also another important aspect in the sense that, as we've seen before, the sustainability report needs to be published together with an assurance opinion, which is basically a check on the substance of the information disclosed. This assurance opinion is expressed by one or more persons or firms that are authorized to give an opinion on the assurance of sustainability reporting. And this has to be under the national law of the non-EU company or under the law of a member state. We have already seen in the previous slide that if the non-EU company does not provide the EU subsidiary or the branch with the assurance opinion, then it will be for the subsidiary or the branch to issue a statement indicating indeed that the assurance opinion was not provided. The publication requirements. So all this information, the general rule at EU level says that it has to be published within 12 months of the balance sheet date of the financial year for which the report is drawn up, in accordance with the company law directive. So basically, it's all into national rules. Of course, in accordance with EU directives, but just to flag that because we're speaking of directives, then national rules might be also imposing a deadline that is a bit shorter than the 12 months, just for you to know. And of course, again, the relevant member state is always the one where the EU subsidiary is established or where the branch is located. The company law directive requires the publication at national level via a business register. And it's important to mention that if these documents that we spoke about, so sustainability report, assurance opinion, and all the necessary statements, if these are not made accessible free of charge to the public on the website of the National Business Register, then they must be made accessible to the public in at least one of the official languages of the Union, free of charge, within the same deadline, but on the website of the EU subsidiary or branch. One very important element that we haven't mentioned yet, all of this will be required from financial year 2024. So if we consider a financial year 2024 that starts, for instance, in January to December, then the deadline for publication will be most likely end of 2029. So it's within 12 months of the balance sheet date. Of course, depending on the national rules, we've seen that already.
Sorry, Julia, I feel I have to interrupt you. You just said 2024 rather than 2028. I think
Apologies.
The first wave was infecting your brain, so sorry for that.
I will repeat to avoid any kind of confusion, and apologies for this. So the requirements for 48 are applicable, as you can see on the slides, from financial year 2028. So if you have, for instance, a financial year that runs from January 2028 to December 2028, then the obligation will be during 2029, within 12 months of December 2028 in this case. But since I said before, it could be even earlier than the 12 months because it depends on national law. So apologies for the confusion. When it comes to responsibility for the compliance with these rules, we have responsibilities from the side of the branch and responsibility from the side of the EU subsidiary. So when it comes to branch, we have a clear responsibility for ensuring, to the best of their knowledge and ability, that the sustainability report is drawn up, published, and made accessible in accordance with the rules for the drawing up and in accordance with the rules for the publication. And the same goes in the case of an EU subsidiary, where we have the members of the administrative management and supervisory bodies that have collective responsibility for ensuring, again, to the best of their knowledge and ability, that the rules were complied with when it comes to drawing up and publishing the information. So what are the requirements for the EU Commission? Adopt the standards to be used for the disclosures under Article 40A. which are currently, as I said before, being developed by EFRAG, adopt them by 30 June 2026 via a delegated act, following all the consultations that we are required to do when it comes to EU bodies. We will also have to make publicly available on our website a list of the non-EU companies that publish a sustainability report. And on this, we may get additional information from member state, but this is just an option for the member states. So we might not have it fully. Member states may inform us of on an annual basis of the EU subsidiaries or branches that publish the sustainability report, and of the cases where a report was published, but where this EU subsidiary or branch has indicated that the non-EU parent did not make the necessary information available. I thank you very much for your attention, and I am, of course, available to reply to questions, if any.
Of course, good afternoon to all of you. Thank you, Giulia. I'm Chiara Del Prete, and I'm the chair of Sustainability Reporting Tag. Thanks a lot, Giulia, for this presentation. I will lead you through some questions that the participants have asked in the chat. How do we calculate the 2 consecutive financial years? So if I have to report in fiscal year 25, is this because in 24 and 25 I am above the threshold? How does it work?
So the calculation is specified by national law. So there are rules at national level that will indicate how you need to consider the calculation for the financial year and the consecutive financial years. So on this, unfortunately, we cannot provide guidance at EU level, but these are usually rules that are specified at national level. So again, the relevant member states, meaning the member states where you have the EU subsidiary established or the branch located.
Other question, does the turnover of the subsidiaries count for the threshold, or is this only the turnover of the parent mother company?
So on the calculation of the net turnover generated in the EU, we have to admit that there are still ongoing discussions internally. So for the moment, unfortunately, we are not able to provide a super clear guidance on this, but we are discussing and we know that this is important to clarify as soon as possible. So we're perfectly aware, but there are discussions on this ongoing, and we will see how to best communicate this as soon as possible the moment that we have a clear reply.
What is the consequence for EU subsidiaries if the non-EU parent doesn't make the relevant information available?
With all the possible caveat, because this feels a bit like a quiz, so I'm trying to reply to all the questions but based on my expertise on the matter. So what the accounting directive says is that if the EU subsidiary or the branch does not get the information, the requirement is to make a statement in that sense. So it seems that the moment you comply with this, that's the compliance. However, let's not forget that there is also an assurance opinion, which is a very important aspect of the checking that the rules are actually being complied with.
And there's probably there could be national specifications as well, right?
I think that there could be. However, at the moment, it's a bit difficult for us because the transposition deadline for the CSRD was 6th of July, but not all of member states have transposed yet. So we do not have at the moment an overview of everything that is being done at national level.
Okay, then the next question would be, when will the Commission assess the equivalence of other sustainability reporting standards?
Let's say that we have the empowerment and there is, I mean, we've done it in the past for financial reporting. So the direction of travel would be to be open to assess equivalence also for sustainability reporting standards. First of all, there have to be sustainability reporting standards that can be assessed. That's the first step by third countries. And then we will proceed. At the moment, this assessment is currently not ongoing yet.
But Julia, it's fair to say that whatever reporting standard is eligible to be assessed for equivalence, first of all, we're talking about standards issued by a jurisdiction. So it is not a third-party private institution that issues these standards. So to be eligible for these assessments, they need to be the standards of a country. And then they need to also deliver the same scope of information of full ESRS. So I would say double materiality, correct? So
this is a clear indication. It is a clear indication in the Transparency Directive. This is where you find the empowerment for the equivalence decision, and there are two conditions that are mentioned there. One, that it has to cover ESG, so environmental, social, and governance factors, and also the aspect of double materiality. But on this, we are really not active yet, so it is difficult to make statements for me at the moment.
Mm-hmm. Is there any exemplary ESRS report already published that we could use as a reference? So we know, of course, that there are early adopters that already in 2023, so issuance 2024, have stated that they have prepared under ESRS, but there is at this point in time there is no public database where these can be found, and anyway, it will not be on non-EU ESRS. Those that you can already find in the market, and there are already studies that have been published on that basis. They are on the full ESRS.
So just to also, because we will issue the slides later, and in the slides I've added the slide that we have about the study that we've done, where we've looked at early adopters and their early practices, observed practices, so not necessarily best practices, but practices that we've seen. Now, this again is full ESRS, not non-EU ESRS, but we include a link for you to that as well, so that you can have a.
But also in that case, if you're referring to the 28 case studies
Yes.
that we have issued, those are obliged starting from 2024. So they don't necessarily issue already in 24 an ESRS statement. That studies about interviews on
Yes.
their preparation process. Is the Commission able to clarify what generated in the EU means for turnover? Is this customer-based, based on cash flows through EU subsidiaries, branches, or in which other way it is calculated?
Another good question, and unfortunately you will be disappointed because as just linked to the reply that I gave before on indeed the net turnover generated in the Union, it is a point where we are discussing, also taking into consideration the practicalities that would involve taking one direction or another. So there is a possibility to consider the net turnover generated by the EU subsidiaries or the branch, and there is also a possibility for the customer location, meaning the sales to the customer. But we are also considering all the implications at practical level and how feasible that would be for a company. So at the moment, we are still reflecting about that.
Okay. Is the group report additional to subsidiary reports?
I would say Yes, but so in principle, the disclosure under 19A and 29A of the Accounting Directive, which is what we call the sustainability statement, so at individual level or consolidated level, is by definition, because we saw it before, has a different scope, is a wider scope by default compared to the one under Article 40A, which is what we call the sustainability report. So I would say yes, it is in parallel. It's not the same thing, and there could be cases where both obligations exist and coexist. However, I said but because there is a possibility, as we saw in the slides, for a company that is under the scope of 40A to provide a sustainability statement instead of a sustainability report voluntarily, so it's not an obligation. But by doing that, that non-EU company would have the possibility to, by reporting at consolidated level under ESRS full, would have the chance, sorry, to exempt all of its EU subsidiaries that are in the scope of CSRD, and that could be a trick to avoid indeed having those two obligations coexist. Otherwise, it wouldn't be possible.
Thank you. Then I have a couple of questions on assurance. First is limited assurance or reasonable assurance. And the second is AA1000 AS accepted as assurance standard under the CSRD?
Okay, on the assurance, a couple of points. When it comes to ESRS, the rules are much clearer. ESRS full, sorry. The rules are much clearer on the sustainability statement. There we have right now limited assurance. There will be EU limited assurance standards, and there is an empowerment for the Commission to require reasonable assurance in the future, subject to a feasibility study, etc. When it comes to 40A, the Accounting Directive is not detailed on this. So we are speaking of assurance, but there is no specific requirement. So on this, we are also reflecting internally. We have so far adopted a first set of Q&As on the CSRD that has been recently published in the official journal of the European Union. In that FAQ, we have a set of questions that cover specifically Article 40A and in general a section on third country companies related questions. So you will find some answers there. We are reflecting upon a second batch, but it's not hasn't been decided yet whether we will do a second batch of FAQs. But this is one of the topics where we are still reflecting. So the same answer I have to provide, unfortunately, for the type of standards that are admissible, because indeed the assurance requirements are not as explicit in the Accounting Directive.
Thank you, Julia. So on the difference between the ESRS full and non-EU, we will have slides, so I don't take those questions. I understand everything discussed in this webinar is relevant for non-EU companies from 2029, but not relevant in their large EU subsidiaries, which will have to report starting from 25. Is that correct? I would say yes. That's
yes, indeed, it is correct. And just to flag that there could be cases where, I mean, if you are the EU large subsidiaries of a non-EU country, because I guess this is where the question is going, just to flag that you might even fall under the first tier of companies that have to reply, meaning from financial year 2024 even, and not just 2025, depending on not only on the size, but on the number of your employees and whether you are a PIE, public interest entity, or not. Because large undertakings that are PIEs, meaning banks, insurance undertakings, or listed companies above 500 employees have to report from financial year 2024, and all the other large in financial year 2025.
Thanks a lot. If I have a branch or an entity that is not 100%, nevertheless, is it again, is it captured by this regulation?
That is not 100%, I'm sorry.
Owned by the non-EU parent.
So I struggle to see how that could be true for a branch, Julia, but maybe you have weird versions here in Europe. But I think for subsidiaries, which is not fully owned, I don't think there's an exemption in CSRD, right?
It doesn't sound to me, but on these specific cases, I would like to consult
judgment
with our with my team. Thanks.
If a non-EU entity decides to report voluntarily under 29A, do Article 8 taxonomy disclosures apply or are they included? And if so, what would be the scope of this Article 8 taxonomy? So the general group or the non-EU? So the EU only?
Okay, so if a company is subject to 40A, it does not have to comply with Article 8 taxonomy regulation disclosures. This is clear. Now the question goes into what if that company voluntarily complies with the ESRS full? And in that case, the reply is still the same in the sense that that company, non-EU company, is not subject to Article 8 taxonomy disclosures, because the scope of the Article 8 taxonomy disclosures is the same as the CSRD. So if you're not captured by CSRD, you're not captured by taxonomy disclosures. However, if you go in the direction of voluntarily disclosing against full ESRS to exempt your subsidiaries, you need to be careful there that your subsidiaries in turn are under the scope of CSRD and are required to issue Article 8 taxonomy disclosure, which means that if you want to exempt them, that information needs to be somewhere, and it can be either in the management report of that EU subsidiary, or it has to be included in the consolidated sustainability reporting of the non-EU company. But it should concern the subsidiary that is being exempted. You don't have an obligation at your level for that, yeah.
Thanks a lot. Assuming that the non-EU company does not publish the assurance report, and the subsidiary notes this as they were to claim a subsidiary exemption, what enforcement action will be applicable to this subsidiary?
The regime for supervision that we have in Europe is, the accounting directive does not impose a national supervisory authority at the level, at member state level. So each member state needs to have in place penalties for breaches of the accounting directive, and that would be national specific, therefore. So it has to be also considered the member state law, because unless a company is listed on the EU regulated market, we do not require a national supervisory authorities to be established. That doesn't mean that a member state cannot, but it's not a requirement.
Thanks a lot, Julia. I think we reached the end of the time allocated to Q&A, but you left us also an email address where possibly other questions may be asked about the interpretation of the law and of paragraph 48 in particular. So thanks a lot. We will project the address later. Then we can move, Frédéric, to present the second part of the slides, which relate to the standard setting activities of EFRAG and the forthcoming exposure draft on non-EU.
Thank you, Chiara. So Michele is showing the slides for us. So, as Julia said, we have to do what we call ESRS for non-EU groups, or NESRS for short, is required by CSRD. We need to deliver to the Commission, as Patrick said, by the end of next year. We expect the consultation period to start beginning of next year, probably, we hope for January. We will circulate the slides later, and you will find on this slide a link to our project page with links to the documents we use for our meetings, as well as the on-demand or live discussions. Then the project timeline. So we've had some discussions at TEG already. We're asking them to vote on Thursday to approve or to recommend to the board the exposure draft. Then we go to the board at least for 2 meetings, possibly 3, depending how difficult this could be. Now, after approval, we normally need a few days, weeks to make sure about our cross-references and formatting and things like that. So that is why we expect to issue only in January. But our consultation period, like Patrick said, is for 120 days. And obviously, we welcome your comments and thoughts on our proposals. So Julia did the converse of what we do on this slide, which is she was sort of talking about all the things that are required in Article 29A, whereas on this slide, we take Article 40A says, look at Article 29A, and then there are 3 exclusions. And that is the driving force of how we approach NESRS. So we looked at those 3 concepts, paragraphs and concepts, and then we eliminated these, the related paragraphs or data points in our ESRS to come up with non-EU ESRS. So the things that we excluded relate to resilience of the group business model and strategy, the opportunities for the group related to sustainability matters, and then also principal risks, including the principal dependencies and how you manage those risks. Now, I do want to caution you here, for example, opportunities. We see that word in the social standards where it refers to equal opportunities for all. Now, obviously, that we didn't exclude because that is not what was meant to be excluded in Article 40. The same with risks. So in some cases, we refer to the risk management of the entity. That is not a financial materiality kind of lens. So therefore, we left those references in. But where it refers to the risks from a sustainability perspective, we excluded those. Then the impacts that we can focus on. Firstly, you have the impacts related to the activities of the EU companies and branches. So this can be the turnover in those companies, and this is basically covered by CSRD Article 19 and 29A. You might have to report if you meet the requirements. However, what the Commission asked us to focus on, and this is really quite important because it could make a difference in certain respects. We have certain examples. So what we are focusing on for non-EU ESRS is the impacts related to the sale of products and provision of services to natural and legal persons in the EU. So it doesn't matter who gives those products or services, who provides that, but it is dependent on who receives those products and services. So we're looking at both humans as well as businesses in the EU. And that is the focus of any non-EU ESRS. If we then look at the perimeter of disclosures, so let's say the scope, there are 2 aspects that we can focus on. So we firstly have the global scope, which is similar to a consolidated financial statements, say at the level of the ultimate parent. So we look at all the impacts related to the activities of the consolidated group on a global basis. So we define this in NESRS 1, which is general requirements. in paragraph 18A, and we say that we shall present a sustainability report at the group level, and under NESRS, it shall be for the group of the ultimate parent. So basically saying that for the ultimate group, if you choose the global approach, your sustainability report will be for that same entity. However, we are keeping in mind that there is also another option. So we call this a mixed approach. So this is where we focus on the EU scope. So this is the impacts related to sales of products and provision of services to people and businesses in the EU for the topical standards beyond climate. Okay, so said differently, you look at the global basis for NESRS 2 and for E1 on climate change. Those are our two standards that we expect a global application in any case. For the other topical standards, so this is E2 to E5, the S1 to S4 standards, and the G1, so the remaining topical standards. For those, you focus on the impacts related to the EU customers. And then you have to make a specific statement in ESRS 2, BP2, that's the disclosure name, disclosures in relation to specific circumstances. So those are the two options that we have. Just to be, can we go back? Just to be clear, so this is the direction we got from the board, and this is the option that was discussed at TEG. TEG will still make their decision, and then the board will still have a decision after that, as I've indicated earlier. So thanks, Michele. If we look at the example, so just trying to explain this concept of the different scopes or different perimeters a bit better, we have an example of a Canadian headquartered group named C. It has a fully owned subsidiary, E, which deals with all the manufacturing, distribution, and other activities needed to sell to the EU. Now, we don't think that this is very realistic. We are just using this to prove a point and to try and explain to you our thinking about this. So that's on the one side. On the other side, it has an intermediate group called R, which does the activities for sales to the rest of the world. So if you were to do 18A, it means that all the activities in the gray would be covered by your report. If you were to choose 18B, so the mixed approach as we call it, that means that for NESRS 2, as well as for E1 on climate change, you would still look at the global picture, but for the other topical standards, you have exercised your choice or the option to only focus on the blue part. Okay, so that would be the impacts that you would be reporting for those standards. I want to highlight here that the value chain doesn't change. The value chain is still outside the group, but the other thing I wanted to emphasize here is that for sustainability reporting, we still take into account the impacts of internal transactions. So we have an example currently in our implementation guidance on the value chain where we say that if one subsidiary sells goods to another subsidiary, from a financial reporting perspective, we would not recognize that revenue and cost of sales. Okay, so we would say that is not a real transaction with the rest of the world, and we would eliminate that. From a sustainability perspective, we would say, well, there were emissions in the transport of those goods. So that, depending on your materiality assessment, would be taken into account in that level. So just a reminder that the internal transactions, there might still be impacts that you have to consider. You cannot just forget about those. We have a second example of a South African company, which, again, similar to the previous one, have mostly its EU activities in a subsidiary called U, but it also has a subsidiary called W for the rest of the world. But W also have isolated sales to the European Union, to businesses or people. So in this case, if we were to do 18A, it's gray again, so the whole shebang, there's no outs there. If we look at 18B, however, we would focus on U, that blue corner, but also the isolated sales. Now, all of this is obviously subject to materiality. So if those isolated sales are really not material, you probably, or the impact related to those sales, you probably wouldn't worry about that. Sorry, I did say sales, but I meant the impact related to those sales. If those are not material, it would not be a concern for you, because we focus on material aspects in ESRS and in ESRS. So you would then look at your impacts related to those two blue rectangles, if I can use that. The last example, which our technical expert group yesterday asked us to add a bit more guidance and maybe expand a bit, but we haven't done that yet, so your slide is still not maybe as complete as they hoped it would be, is where you have a fully integrated manufacturing and distribution system. So we think this is probably the case for most of the scenarios where companies would not distinguish between whether they're selling something in the EU or not or outside the EU. So for when you use 18B, you would look at your materiality assessment for topics beyond climate to look at all the impacts, also those arising outside Europe, if they are connected with your EU sales of goods or services. And then for the quantification of those metrics, you would need to look at those impacts. Now, we're going to give you a bit more information there. Our thinking at this stage is for environment. People are used to using proportions for, say, pollution or for emissions, etc. So we probably could do something like that if it really isn't clear how to distinguish between EU and non-EU. But for social and governance, we don't really do that because it's more binary in nature, and just a transgression of, say, human rights is quite significant in and of itself. But we will expand on that guidance in the exposure draft, still work in progress. So if we compare ESRS Set 1, which is what the EU companies are applying, versus the non-EU ESRS. So very important, we have 12 standards on both sides, and they follow the same numbering. The other thing that we are trying to do is that we are really trying to maintain the paragraph numbers so that the Q&A and implementation guidance documents that we are issuing for ESRS, that you can use those for the non-EU ESRS documents as well. From an ESRS perspective, of course, we have double materiality, so we have both impact and financial materiality, but per CSRD, we excluded risk, opportunities, resilience, and dependencies, so that is mostly impacts that are left over. I do want to highlight here that we did not exclude all financial information, because sometimes financial information gives really useful information about the impacts. So you can't just go, oh, this is a number, so EFRAG would have excluded it. It is a bit more nuanced than that. Then the perimeter of disclosure. So for EU headquartered companies, they have to apply ESRS to all operations in the EU or not. So they don't have a choice, whereas as I've discussed here, for non-EU ESRS, you have the global or mixed approach at this stage per our thinking, but you always have the option, no obligation, to do full ESRS. We obviously would love that and would encourage you to do so. You might decide that it's worth it for the subsidiary exemption. ESRS includes the value chain, as does non-EU. Incorporation by reference, we try to make that work, but it proved really, really difficult in our TEG. So at this stage, we don't have it included, but we will continue to see if there are maybe ways that we have missed. For transitional provisions, originally we thought this is not required for non-EU because the non-EU groups have far more time compared to EU companies who had to report in 2024 or 2025. So that was our original thinking. However, we did change our thinking when we realized, oh, comparatives may be quite difficult in the first year of application, even for non-EU, and for the auditing process would be too complicated. So we changed that. And then for those groups who only qualify for the Article 40 reporting after 1 January 2029, we do think that the phasing in provisions could be relevant. So we restored that to make sure that there's a level playing field, not both ways, that we are not asking more of non-EU companies than we're asking of EU's companies. And then the taxonomy related disclosures that we have in ESRS 1 mostly, as well as a bit in E4, we've removed those because it's not relevant for companies in this scope. And I think that is it, Kiara. We do have some polling questions we want to ask you. So from which country is one of the questions we have for you. I think this was sort of the Swiss, but there was already a lot of Swiss this morning in our group. But so are you from African countries or from the EEA countries possibly? So we have some participants responding. The other question that we have is what type of stakeholder group you represent. This is also interesting for us. This morning we had a lot of consultants. We had some preparers as well, and some auditors, of course, which I think is expected. Oh, we have some of the US. You're a bit early. We expected you only tomorrow evening, but welcome. Netherlands, UK, those are to be expected. Germany. We do have quite a lot of EU companies joining us as well, for their parents, obviously. Irish, US again. Can I see the participant, the types of participants, please, Michele? Okay, so the consultants and the assurance, yes, we see some movement there. And then can you go to the next question? So, Chiara, this is also quite interesting, the sustainability reporting frameworks in 2028. So is it TNFD, SASB, GRI? So the
I think something else means because the local territory, the ISSB is adopted by the territory is
already an
option. So it's really something else.
Yeah, so that's quite interesting.
Interesting, very interesting.
And then the last question that we have for you was for your non-EU reporting for the group, what framework are you thinking? So many of you are not reporting companies, not preparers, so we expected that. Some of you are still deciding, which I think makes complete sense. Some of you definitely have decided non-EU. And then some of you are very brave and have decided to go for full ESRS. I do want to say we did a provisional data point count and we have to refresh it after some of the changes. But we thought that the difference is about 10% in the data points between non-EU ESRS and full ESRS. So that is just to give you an idea. So, Chiara, I think that is it from us. So if you have some questions for us, then we can deal with that.
Yes, sure. So that's interesting question. Will there be major differences between ESRS and non-ESRS, non-EU ESRS, and will the ESRS and ISSB interoperability guidance be equally applicable? Maybe I can take this.
Because it's been a passion of yours.
Yes. So Fredra explained already the differences between non-EU ESRS and full ESRS. Main difference is impacts as a focus in non-EU, as opposed to double materiality, so impacts, risks, and opportunities in full ESRS. And this comes evident, the data points in ESRS that cover risks and opportunities and are also by definition interoperable with the IFRS are not going to be there. We are going to consult, so one of the questions of the consultation will actually be interoperability and possible incorporation by reference from one report to another. Anyway, there are also many impact information in IFRS, which are also common to ESRS. Therefore, the interoperability guidance is still applicable for the remaining data points, meaning the data points that have not been eliminated because they solely refer to to risks, opportunities, and resilience. We may at some point, not sure when we will have completed the exercise, but as part of the package for consultation, it would be nice also to explain a bit this aspect and to identify in the non-EU ESRS, which are the data points in common with the ISSB. But I would imagine the more important aspect is the complementarity between the two more than the overlap. So there is an overlap because there are many impact information in IFRS. Take scope 1, 2, and 3, for example. But per se, the information about financial effects, financial risks, opportunities, etc., those are complementary. So it's more a matter of how do we avoid double reporting and try to incorporate by references and things like that, where we want to ask specific questions in the consultation. Then another question, maybe it's more an observation than a question. On 18B, a lot of international groups are now looking at doing a global full ESRS report. And the multiple complexities that are now introduced by all these nuances under the mixed approach. Is this ultimately beneficial to achieve comparability and meaningful information that we are hoping to achieve through the implementation of both ESRS and non-ESRS? And doesn't this mean also that we sort of move away from interoperability with ISSB and GRI? I don't know, Patrick, if you want to take this. I see you still connected, at least. Or maybe he's just spying on us. Yeah, well, then I would say it's an interesting perspective. It's the type of feedback that we would like to receive as part of this consultation. The consultation, I mean, the question will be there in the consultation. So benefits and costs are equally part of the feedback that we would like to obtain. Then another question, will sector standards apply to this package of standards?
So if you look at CSRD, it doesn't refer to set one. So when we refer to set one as a sector agnostic standards, that is just for our own use and a way that we refer to the standards. But CSRD obviously didn't use this kind of terminology. So our thinking is that it is possible, and we are preparing on that basis, but the board has indicated that that is their thinking, but there hasn't been a firm decision. What we are planning to do when we do issue our sector standards, also hopefully by the end of this year or beginning next year, is to have a section where we indicate what the impact would be for non-EU groups, i.e. excluding risks and opportunities, dependencies, related data points. So we do see this as part of the regime. Of course, that depends on what happens with sector standards in general, and then the application dates, etc., would also be subject to those kind of factors. So we do see that as part of it.
Given the Commission new focus on reducing the reporting, should we expect a shift in EFRAG mandate? Or is the manner in which EFRAG has approached the non-ESRS using ESRS and taking out some non-relevant disclosure a reflection of simplifying the reporting? I would say we are moving under the content of the CSRD, and there is no intent of simplification when we look and at the reason for having a non-ESRS. Quite the contrary, in the sense that we want to have level playing field. So simplification is not the reason why we are eliminating a minor part, I would say it's only 10% of the data points. We are eliminating the data points that pertain to risks, opportunities, resilience, because these are not to be covered under the CSRD. Since the non-ESRS apply only to impact materiality, while the EU subsidiary are required to perform double materiality, does this mean that non-EU companies must also conduct double materiality as part of their reporting obligation?
So you obviously need, well, I guess it depends what you're trying to achieve. So if you're trying to do your non-EU obligation under 40A, that is focusing mostly on impact. Whereas if you're trying to comply with your requirements of your subsidiaries under 19 or 29 A of the accounting directive, then that would require a double materiality assessment. So it depends what you're trying to do and why. But 40A is impacts.
This is interesting, Prodre. We were discussing a few days ago the role of this artificial consolidation and whether it is under Article 40A, what's the relationship there? So is the practice of artificial consolidation where companies consolidate information from EU subsidiaries into a single report rather than adopting a global or mixed reporting approach considered acceptable or advisable?
So here you have to be quite careful. So just a reminder that you would apply 48I of artificial consolidation when you are trying to get an exemption for your subsidiaries and their reporting duties under CSRD. So that means full ESRS, double materiality, the whole shebang. You cannot just escape that. So it's not that 48I that is just trying to help you with your burden for your subsidiaries. Whereas 40A is trying to look at your global, is trying to provide information at a consolidated level or at a group level. So the objective here is slightly different. Now, exactly how those two will interplay is not 100% clear from the guidance. And I think that Julia will agree with me that this is one of the things that the Commission will probably still provide further information on.
Then there is a question to clarify the by reference point. I think this is for me because I referred to the question that we are going to include in the consultation on whether we should allow to incorporate by reference from IFRS S1 and 2 to the non-EU. And by reference means that instead of when two different reports are prepared under two different sets of standards and require the same information because there are common data points, then you can comply with one making reference to the other report. This is possible under full ESRS at a number of conditions. First is that the report needs to be available at the same time with the same digital characteristics, with the same type of assurance. And then there are there is a limited list of possible sources where you can incorporate by reference. The orientation, at least at tech level, has been to not to allow incorporation by reference in the non-EU for a complexity related to languages. Imagine having the non-EU report prepared in a language of the EU and the IFRS report prepared in another language. So not to enter into those complications, we were, I mean, the tentative direction has been to say that that's not possible, but still we are going to at least consult on possible incorporation by reference from IFRS for the remaining areas of overlap to avoid double reporting.
Chiara, I see some questions on the responsibility for doing various reports. So just to be clear, 40A is a responsibility of the sub in the member state that is a private PIE, so a public interest entity or a branch, if it meets those requirements, the requirement is on that entity or branch to do the reporting, so not by the parent, and it doesn't have to be in the financial statements because this is something completely separate. When we are talking about the 48I kind of consolidation, that is normally done by the biggest entity of the ultimate parent in the EU. So that is sort of then determined to be the lead, I don't know, fake parent or fake intermediate parent. I'm not sure what's the best way to term that. But so you do need to consider that these are different situations and therefore that different rules apply. 48I is for your normal obligations under 19A and 29A. So the timelines, etc., for that is different, and there it would be form part of the management report in the and the annual report kind of thing. So just be very careful. Go back to the accounting directive. Make sure that you read 40A to D for the non-EU part, and then 48I for the artificial consolidation point.
Can you explain if financial materiality has been fully excluded from the non-ESRS? And if yes, then why does interoperability with standards having double materiality apply? So we had to eliminate impacts, the data points which are solely related to, risks, opportunities, and resilience. We also eliminated the dependencies. But this doesn't mean that the report will not cover at all financial information, because there are financial information that are needed in order to understand and explain impact-related aspects. So take the example of transition plan, where the amount of investments and resources available, it's essential in order to understand how serious the company is in the transition efforts, etc. So that's an important point. Why interoperability still matter also if we don't cover risks and opportunities? Because there are many data points related to impacts in IFRS S2 and S1 also in general. So, for example, all the areas related to the transition plans themselves, but also the GHG emissions in terms of impact matrix, those are impact elements, so are still covered in ESRS, in non-EU ESRS, and therefore require a consideration of at least incorporation by reference in this case. Then there are again many questions, Frederic, which ask about the question about the interaction when I have subsidiary that is in the CSRD scope, and then I have the parent that later on will be obliged to prepare under the non-EU. If I want to exempt the subsidiaries from the preparation, does it mean that the parent company needs to prepare a full ESRS under double materiality and cannot anymore use the non-EU ESRS? That would be good to clarify.
Yeah, so I think Julia had it on her slide. So I think it was 40A2, and it was the second subparagraph or something like that, says that you can do full ESRS. And of course, if you want to exempt your subsidiaries from that, you have to comply with the full ESRS, because we cannot have EU subsidiaries doing less, i.e. only focusing on impacts compared to other European companies. That would just not be fair.
And this question, which I'm not sure I grasp completely, can we think about harmonization in the sense of unifying ESRS and non-ESRS? I think they are already harmonized because it's the same. We are simply copy-pasting ESRS. And by the way, we're not going to consult on the content of ESRS. Our consultation will only be limited on the changes that we are making. So the elements that have been excluded, the option in 18B, the incorporation by reference, some other aspects on potential internationalization of some aspects of EU regulation that are embedded in our standards. So it will be a very focused consultation with reflecting on the fact that we are using the same standards, basically. We're only doing some changes in order to comply with the exact scope.
Yes. So I don't think we see any further combining of those two. I mean, if you can adopt normal ESRS, but we don't at this stage. The legislators kept those separate, so we will continue to do so. So we do have a question about our materiality impact, or the impact materiality and not financial materiality in non-EU. So we weren't part of the debates and the discussions. So these kind of things were agreed by the EU Council, the European Parliament and the Commission. That negotiations EFRAG does not form a part of. What we think, we don't know, but one of the things is that we think it does complement, say, the financial materiality view under ISSB. And so therefore it sort of avoids duplicating. However, what I do want to say, we had some questions earlier, whether you could say that, say, impact materiality under GRI plus ISSB, does that equal ESRS? Under no circumstances, no. We have EU-specific data points that are required for EU legislation. So you cannot just assume that GRI plus ISSB will take you to ESRS or non-EU ESRS. So we do want to emphasize that. You can do that, but I think it's a very long-winded way to get to the answer where you need to be. So I would go back to the source, but that's my view. And obviously we are writing the standards here, so that is our view. But I think to try and do it differently is quite a convoluted way. Chiara, you've got our email address and FISMA's email address.
Exactly. So for questions on legal interpretations of the CSRD, so scope, what does the parent, so scope and shape of the report of the parent versus the branch or the subsidiary, location of the reports, exemptions, assurance, its enforcement, this is for the Commission. And for the standard setting, the option that we presented and the exposure draft, then you can contact us. And it will be also interesting to have as many as possible companies and also users to run our field test, because we want to field test the standard and also the option. Talking about the option, there is another question. Is option 18A or B a real choice, or will they, or will it be mandated?
Well, we can't say for the board, right?
Well, no. According to the strategic directions that the board has taken 1 month ago, which was before the deep dive into the drafting, we will have a mandatory application of the global scope with the free option to, instead of reporting global, for topics other than climate, limit the topical disclosure to impacts which are connected to the sales of goods and services to EU businesses and customers. So ESRS 2, always global. E1, climate, always global. Then when it comes to the other topics, social, governance, pollution, etc., you have an option to limit the disclosure to the impacts which are related to the provision of EU customers. And indeed, one of the elements that we want to investigate in the consultation is the feasibility of this option, the approach to calculate the metrics in that case, and so on and so forth. So when we talk about materiality assessment for climate, this is global. For all the other topics, if you choose to report to global, is global. If you choose to report on the mixed approach, so limiting the other topics, for this, you need to disclose about impacts which are connected to the EU, sales to the EU. And one of the questions in the consultation, and in particular in the field test, will be how to practically trace back the disclosure related to governance or policies, action targets, in order to capture the scope of this specific disclosure, because you need to take all your impacts and slice them down depending on which ultimate product or service they contribute to.
I just want to highlight again that I think I've mentioned it, but in the slides we have some other links that are useful as well. We have some implementation guidance that we have done for the normal ESRSs. We give you links to that. We give you a link to the project page. Also the FAQs of the commission that Julia mentioned. So all of these will have links and will be available on our website. And you can find further information there, which hopefully will help you. Chiara, I think that is it. Yes, the value chain is not amended. We still require all the value chain requirements. I see a question there. I am the queen of the value chain along with non-EU ESRS, and value chain is required in full. But again, not to go hysterical on value chain, our requirements are quite specific in that area. We have some qualitative things that you need to do about your value chain. So that you can normally do in-house. You don't need to send out surveys and whatever. For policies, actions, and targets, it is your policy with respect to the value chain, so you don't need to check their policies, actions, and targets. CSRD may require something else, but our reporting is based on your policies, actions, targets. So if you don't have a Scope 3 target, that is fine. Just tell us, I do not have a target for Scope 3. So my value chain, there's no target. So transparency is the important thing more so than the behavior. And then for metrics, the real numbers that we're thinking about is really Scope 3 emissions and reductions in those emissions. And then when you think about microplastics, you have to take into account the microplastics that get emitted through use. So not just when you produce the products, but also when they're used, like rubber tires or things like that. So just a little freebie on value chain while we're on the topic.
Okay, then I think we can wrap up. And thanks a lot. Thank you, Giulia Bottazzi, again from the Commission for having been with us. And we really would appreciate if you could participate to the consultation and also be part of the field test, and stay in touch for the next steps of this journey, because we are only starting now.
Thank you. Have a good afternoon. Bye.
Thanks a lot.